Hello, everybody, and welcome back to another episode. My name is Jordan, the Millennial Investor, and we are going to give a monthly update on my portfolio. I know I'm a month behind, but essentially, this is to give you an update with what's going on with me and my investments and how I'm doing so far in 2023. Which, as you can see from this picture right here, I am not doing very good at all. I have definitely fallen behind the curve. We are pretty much lagging between all the major indexes, and so far, the NASDAQ is absolutely killing it this year. As of Friday's performance close, they closed at 32.76% on the year versus my return of 5.4%, which we are far behind. Versus the S&P, it's 16.6% versus my 5.4, and we're going to show you an updated holdings page of what I have so far. And let's go ahead and do that right now. Now, this looks different from the last time I gave an update. You've seen some positions have been added, removed, changed, all that good stuff. And right now, this is what I currently have in my portfolio. We still have the largest position in my portfolio being Croc stock. Second place, we have Target, making up right around a fourth of the portfolio. We have Dropbox, which still makes up about 1/5 of the portfolio. Then we have a slightly smaller position than that, which is PayPal. And I want to go ahead and give my updates and brief overview of how I feel about these companies and what I'm going to do moving forward. Now, this portfolio balance here that I track monthly since starting my YouTube channel all the way back in 2020 with my $1,500 initial deposit, we have slowly grown that over time. And you can see as of November 1st, I always update this at the first of the month, we've fallen down to 42,000. Now, a couple days later, I'm filming this on November 11th. So 10 days later, we have gone up quite a bit, all the way back up to 48,000. So that is a pretty good recovery there. And I have made some initial deposits back. And you'll notice there's also a new cash/savings account, which I actually brought my savings and cash pile over to Fidelity so I can start accruing some sweet interest. Because as you can see right now on the cash pile, they are currently paying out almost exactly 5% on your money. And so what I'm currently doing on that is I'm selling puts, which will make money. And then of course, those puts and the premium that I'm receiving for it will accrue interest at the same time as well. So on top of this 5%, a couple of percent from year on top of that from selling puts, ideally it'd be nice if I could earn a solid 10% or so on my money each year for my cash and savings. But this is going to be a conservative portfolio, mostly selling puts, not going to be any major investment. So I won't even really cover it on the channel, or I might bring it up briefly once every now and then. But that said, without further ado, let's go ahead and start with our smallest position and build up. Let's go ahead and start with PayPal. And I want to tell you, I am more confident in PayPal than I am right now than I ever have been. And something I want to mention, let's go ahead and pull up PayPal Investor Relations. And let's look at the most recent earnings report that they did. And I want to show you something that was very interesting to me. All the time I talk about cash flow. And cash flow is very important to me as an investor because I think it is the most important metric to see whether or not a company is actually profitable or not. Now let's go ahead and go to the cash flow here and let's look at adjusted free cash flow. Now you'll notice that initially, if you look at this chart, let's go to the quarterly chart, you'll see that they put up a pretty regular number of 1.1 billion. Now last quarter, they did have a one-time write-off due to some layoffs, and that did hold up some of this free cash flow number, so it looks way worse than it actually is due to a one-time exception. Now this number, 1.1 billion, in this coming quarter, this is pretty much right on par. They've been producing right around $1 billion or so every single quarter. Now, what's the reason that I'm bringing this up to you, and why am I going to bring up the adjusted free cash flow? You'll notice that they had a 0.8 billion adjustment for held for sale, HFS. That is a held for sale impact for them selling off this buy now pay later business. So this is another one-time write-off. And what this means is that if this wasn't here, the free cash flow actually would have been $1.9 billion, just under $2 billion. And you'll notice that's higher than pretty much all of these numbers you see here, the highest that they would have produced since the middle of 2020 in the pandemic when everyone was locked in. And if you look over a 10-year span, that's basically one of their highest ever. They would have been around this $2 billion mark, way up here where my mouse is, where I'm moving it. So this is a dramatic improvement in free cash flow. On top of that, they still had their consistent and steady revenue growth. They did hit an all-time high this quarter of 7.42 billion, and they are projecting more growth this coming quarter, so expect that to hit another all-time high around 7.5, 7.6 billion or so coming into the next quarter. So this is looking good for PayPal, but something I want to mention as well, and this has nothing to do with numbers, this is all qualitative. If you look at this earnings call for this company, the new CEO CEO has a perspective and a vision and a new outlook on the business that is completely different than anything I've seen in the past. So overall, if there's anything that gets me excited for this company, it's the numbers and it's the CEO and it's a historically low valuation. Because even if you look at this company's historical free cash flow on an annual basis, they've been producing around 5 billion. And comparatively speaking, if you look at this company's market cap, you can see that right now it trades at 58 billion. If you take 58.5 and you divide that by 5, the free cash flow in a year, that is an 11.7 free cash flow, price to free cash flow. So a 12 price to free cash flow is already super cheap, and that is assuming they're not growing this, which we know in the last quarter they are. It's very reasonable to expect that in 2024, they could probably put up something like a $7 billion free cash flow number, and if they were to put up a $7 billion free cash flow number, that takes this 12 price to free cash flow all the way down to an 8. So this is one of the cheapest stocks in the market. They're heading in the right direction. They're still growing revenue. They're still growing profits. And more importantly, they have a CEO that is now hyper-focused. They're selling off their less profitable businesses. And I think this share price, 1 year from today of $54, is going to be nowhere near this price. I would not be surprised. I think that there's a reasonable chance that this stock is at least 50% higher. I would say that the stock is at least $75 or more. Very decent chance that I think it's $100 plus. So we'll see. I could be wrong about that, but that's why I'm holding PayPal. Dropbox is one that I've been holding for quite a while now. I'm actually curious, how long have I been holding Dropbox? I bought my initial shares back in February of 2023, so we're getting close to a year now. The good news is if I can hold these a couple more months, I'll get my long-term gains rather than short-term capital gains, so that might be what I end up doing. But basically, I'm looking on selling out of this position totally around $35, but Dropbox has been doing as steady and consistent as I thought it would. Now, I never thought that this company was going to double up or triple up or have some incredible performance that no one could foresee, but the revenue growth is about as consistent as it comes. Quarter in, quarter out, steady revenue growth, and the profitability is looking just fine as well. You can see it that in the most recent quarter, they just put up a record free cash flow number, still growing their profits, still growing their revenue, as you can see. And the main thing too, and I didn't even mention this for PayPal, because the same thing applies to PayPal as well, they're consistently buying back lots and lots of shares. As the share count goes down over time, they're buying back lots of the company. Just within the last year, they bought back around 4% of the stock just for holding it. So that's really impressive. Average 6.7% over the last 2 years. Now, this is a company that has gone up a little bit in share price. They've done decent over the last year or so, don't get me wrong. But this is still, historically speaking, if you look at the full track record since Dropbox has been public, it's went nowhere. It IPO'd right around $30. Today, the stock price trades right at 26. So that is far off from its IPO price. You can see that the revenue has gone nowhere but up, and the profitability has once again, just like the revenue, has gone nowhere but up, gone in the right direction in the way you want to see as an investor. As the share count goes down, as the profitability goes up, and once again, this company has a solid balance sheet, also like PayPal, I forgot to mention. This company has more cash than debt, so they're essentially unlevered. They have no debt that's weighing them down. This is a profitable business that's producing hundreds of millions of profits every single quarter. This is one that I think is a steady gainer. It's a very boring stock. This is not one that's going to have some skyrocket price where it doubles next year more than likely, but it's going to be a slow, steady gainer that I can get some consistent options money from and hopefully share gains over time as they get more and more profitable. Target. This is a beaten down dog stock that has went down so much over the last 2 years. So much. Let's just look at the stock performance. You can see, let's look at the 10-year chart. Target stock went all the way up to around $260, $270. But let's zoom in here over the last 5 years. They reached this high around $260, $270, and ever since then, back at around August of 2021, a little over 2 years ago, this company has been on a steady downtrend to fall below 200, to below 150, to even at one point fell below 100 for a very short brief period of time. Now right now the stock, let's zoom in even closer, right now the stock currently trades at around 110 or so. I bought my shares right around the same price. My average share price is 114, so I'm just about break even on the stock, down very slightly. And this is one that I think, just simply put, it has been oversold so much that I think they're due for a bounce back. The revenue has stayed mostly consistent. It has flattened out a bit, but I think they're going to return to revenue growth if they can raise prices and open new stores and close out the less profitable ones. And speaking of less profitable, you can see that the profits have really shrunk. If there's anything that has taken the stock price down, it's this. Now you can see in this last quarter and the last 2 or 3 quarters, they've really started to get profitability turned back to the positive way. I think as they close down these unprofitable stores and they sell them off for cash, I think that they're going to get this free cash flow back to a positive number. And if you look historically speaking, while the free cash flow has been a little bit wonky over the last couple of years, you can see that generally speaking, this is a company that every year produces around roughly 4 or 5 billion in free cash flow, generally speaking. And if you just look at this price of $50 billion, if they can get back to a point of even remotely getting close to 4 or 5 billion in free cash flow, that means that this company is trading at rock bottom prices. The cool part is that while you wait, this company's going to do a couple things for you. The first one is that generally speaking, shares trend down over time. So they're buying back stock. You can see just like if you look 10 years ago, this company had 638 million shares outstanding. And now from 638, they've decreased that all the way down to 462. So you're owning more of the business just for waiting. And also, this company pays a juicy dividend. They did just raise that dividend as well. And they're now paying 1.1 per share every single quarter. And so for like someone like myself, when they're paying out a little over $4 in dividends every year, I own 200 shares of the stock. I'm going to get paid just under $1,000 a year just to hold it. So even if this company goes nowhere, I will sell options like the ones I have right now, these two that I'm highlighting with my mouse. These two are options that I have currently open on Target. So I will earn options premium, and I'll earn a little under $1,000 a year for holding the stock as well. So Target's one that I own, one that I think will bounce back. It's probably not going to be a long-term hold for me, but I could definitely see myself owning it over the next couple months, or if not over the next year or two. Finally, we have a stock that has absolutely crushed my portfolio. We're down $11,000 on, and this is the main reason why we've been lagging so far towards the back half of the year, because CROX, Croc stock, is really having a tough time. And this company has been doing great fundamentally. Its actual business has been hitting record number after record number. They're putting up $1 billion in revenue now, which is pretty much the highest they've ever been. And the free cash flow, the actual profitability is coming in as steady as ever. While they did just put up a record number last year in the fourth quarter, I'm interested to see if they can meet or even exceed that number this year. But the thing is, if you look at the most recent quarters, the last two that they've done, and compare them to last year, you look at the June quarter this year, they put up about $300 million in free cash flow. Let's compare that to a year ago. They only put up 136. So free cash flow over doubled in the June quarter. Okay? Actually, I should probably start to the beginning of the year. The first quarter, they lost $100 million. This year, they only lost 17. So they improved by about $100 million in free cash flow that quarter. Like I said, quarter two, they doubled. They improved by about 160, 170 million. In the third quarter, the most recent report, last year they did 130. This year they did 215. Once again, nearly a double up, improved almost $100 million. So they are hundreds of millions of dollars across from free cash flow in terms of improvement, where this time last year, in the first 9 months of the year, they produced somewhere around 225 million or so in free cash flow, whereas this year alone, they've produced almost $500 million. They're almost $100 million, they're almost $200 or $300 million ahead in free cash flow this year so far in the first 9 months of the year. So last year's annual number of free cash flow coming in at right around 500 million. They've already reached that number so far, and we still have a whole nother quarter to report. So don't be surprised if they end up coming up with a $700 million plus free cash flow number, especially as we're nearing Black Friday and the holiday shopping season and New Year's discounts and all that good stuff. I think that this company is set up very nicely. And you'll notice that if we look at the share count over time, you'll see that they had a big dip. Let's go ahead and look at the most recent. Let's look at the 10-year. You can see that they steady went down, and then it stopped right here in early 2022, late 2021. Now, you'll notice the reason why this happened is because they acquired Hey Dude. Share buyback stopped right here, and then shares pretty much either stayed flat or even trickled up a little bit until the most recent quarter. For the first time, we actually saw a downtick because this company just started buying back shares. Now, this company is going to do two things. One, they're starting to return share buybacks in a big way now this quarter. This current quarter and Q4 and quarter one into next year is coming back stronger than ever, but the most important thing is not only are they going to start buying back more shares, but the share price is going to be the best that it's been in years. You can see going back several years, this company was $100, $150, at one point almost $200 per share. It reached the 180s at one point. Well, today they can buy back those same shares of stock for only $79. So they're going to be buying back lots of stock. And like I said, similar to my other companies, if you look, this company has a ridiculous price to free cash flow. The market cap is around $5 billion, but they're going to put up around $700 million in free cash flow. So this company is well into the single digits of price to free cash flow at around a $5 billion company. I'll take that all day long. So while Crocs has not performed well, and I probably did buy before it really reached a near bottom, I am getting a lot of options premium from this company, and it is one that I think will heavily bounce back. If it does not, they'll continue to buy back 8, 10, 12% of the shares back of the company, especially going into next year in 2024. So it's one I'm confident in, one I'm going to continue to hold as my number one position. And while Hey Dude sales has slowed a little bit, the international sales for Crocs has absolutely exploded. So I think this company, like you can see from their net income over the long term, they're just heading in every right direction from what you want to see. So while it's easy to get scared out of a stock that is going down, the actual fundamentals themselves are heading in the right direction. Thank you all so much for watching. Check out M1 Finance down below if you're interested. But other than that, guys, thank you all for watching, and I'll catch you all next time.